Why is the Japanese yen so weak? And will authorities intervene? April 1, 2026. Japan's weakening yen has become a major concern for policymakers, especially as it pushes up import costs and strains household finances. The pressure intensified in late March 2026 when the currency fell past 160 yen per dollar for the first time since July 2024, a level that previously triggered government intervention. Officials have since issued stronger warnings, with Vice Finance Minister Atsushi Mimura signaling readiness to take decisive action against excessive market moves. The yen's weakness is driven by both recent geopolitical developments and longer-term structural factors. The ongoing U.S.-Israel conflict with Iran has increased global oil prices, which heavily impacts Japan because it imports nearly all of its energy, with over 95% of oil coming from the Middle East. Higher oil prices mean Japan must buy more dollars to pay for imports, increasing demand for foreign currency and weakening the yen. At the same time, interest rate differences between Japan and other major economies, especially the United States, continue to weigh on the currency. Japan's rates remain very low even after a recent hike by the Bank of Japan, making the yen attractive for carry trades, where investors borrow cheaply in yen and invest in higher-yielding assets abroad. This dynamic creates persistent selling pressure on the yen. While a weaker yen has boosted tourism and supported export-driven companies, it has also raised import costs for energy and raw materials. This has contributed to inflation and a rising cost of living, squeezing households and domestically focused businesses. Economic strain linked to these pressures has already contributed to political instability in recent years. There are also international considerations. The United States has expressed concern about yen weakness, with President Donald Trump arguing it gives Japanese exporters an unfair advantage. Currency levels have been a point of tension in trade discussions, increasing pressure on Japan to manage exchange rate movements carefully. Currency intervention is one tool available to authorities. This occurs when the government, through the central bank, directly buys or sells currencies in the foreign exchange market. In Japan, the finance ministry decides when to intervene, and the Bank of Japan executes the trades, typically by buying yen and selling dollars to strengthen the currency. These operations are funded using Japan's large foreign reserves, which stood at about $1.18 trillion as of February 2026. However, intervention is generally seen as a temporary measure. While it can quickly stabilize markets and signal resolve to speculators, it does not address underlying economic factors like interest rate gaps or trade imbalances. As a result, unilateral intervention is unlikely to reverse long-term trends, though it can buy time. Japan has a history of stepping into currency markets, spending nearly $100 billion in 2024 to support the yen. Notably, intervention has often occurred when the exchange rate approaches 160 yen per dollar, making this a key psychological threshold for traders. Authorities sometimes delay confirming intervention to maintain uncertainty and deter speculation. In addition to direct intervention, officials use verbal intervention, carefully worded warnings, to influence markets. Statements suggesting readiness to act can move exchange rates by signaling increased risk for speculative traders. When intervention does occur, its effects can be immediate and sharp. The yen has historically strengthened by several yen per dollar within hours, causing sudden losses for traders betting on continued weakness and complicating business planning. The United States generally supports intervention aimed at stabilizing excessive volatility but opposes actions designed to gain trade advantages. While Japan is monitored for its currency practices, it is not officially labeled a manipulator. In practice, Japan retains some flexibility to intervene, especially when moves are framed as efforts to maintain market stability rather than competitiveness. By Bloomberg Originals, story by Erika Yokoyama, April 1, 2026.